Right now, Medicare is charging millions of married couples hundreds of dollars more per month than they should be paying. Not because their health changed. Not because they switched plans. Because of a single income rule that Medicare recalculates every year using tax returns from 2 years ago. And most couples have no idea this rule exists until the surcharge is already being deducted from their Social Security checks. Before we continue, every form, every deadline, every exemption I just walked you through, I've put it all in one place. State by state, form by form, laid out so any senior can find exactly what applies to them in under 5 minutes. It's called the Senior Benefits Playbook. It's in the first pinned comment right below this video. Tap it once, and you'll have everything you need. Now stay right here because the next section is the one most people miss. The rule is called IRMAA. It stands for Income Related Monthly Adjustment Amount. And in 2026, it quietly became more expensive for married couples than ever before. Here's how it works. Medicare determines your Part B and Part D premiums based not on what you earn today, but on the modified adjusted gross income reported on your federal tax return from 2 years prior. Your 2026 premiums are based on your 2024 income. If your combined income as a married couple filing jointly exceeded $218,000 in 2024, Medicare added a surcharge to both of your premiums. Not one of you. Both. And it did this automatically, without a phone call, without a warning, and without explaining that you may have been able to avoid it entirely. My name is Thomas. I study the federal benefit rules that affect seniors and retirees. The rules that government agencies will not explain to you unless you already know the right questions to ask. And this rule, IRMAA, is the single most common reason I see married couples losing thousands of dollars a year in retirement income they did not need to lose. Not because they are wealthy, because they tripped over an invisible income line that no one told them was there. Here is what it costs. In 2026, the standard Medicare Part B premium is $202.90 per month. That is already a 10% increase from last year's $185. For a married couple both on Medicare, that is over $4,800 a year just in standard premiums. But the moment your joint income crosses $218,000, the IRMAA surcharge kicks in. At the first tier, each of you pays an additional $81.20 per month for Part B, plus $14.50 for Part D. That is $95.70 per person per month. For a married couple, that is $191.40 per month in surcharges alone. Over a full year, that adds up to $2,297 on top of your standard premiums. Cross the next threshold at $274,000, and the annual surcharge jumps to more than $5,700 for the couple. And at the highest tier, a married couple can pay nearly $14,000 a year in surcharges alone. Here's the part that catches most married couples completely off guard. The IRMAA brackets are not gradual. They are cliffs. If your joint income is $218,000, you pay $0. If your joint income is $218,001, you pay the full surcharge for that tier. $1 over the line costs you over $2,000 a year. There is no phase-in. There is no sliding scale. There is no partial surcharge. You are either below the line or you are paying the full amount. And most couples do not find out until they receive a notice from the Social Security Administration telling them their premium has already been increased. Let me show you how this happens to couples who are not wealthy. Consider Harold and Elaine. They are both 68. Harold receives a pension of $54,000 a year. Elaine collects Social Security of $22,000 a year. Together, their base income is $76,000, well below the IRMAA threshold. But in 2024, their financial advisor recommended a Roth conversion of $150,000 from Harold's traditional IRA. That conversion counted as taxable income for 2024. Their modified adjusted gross income for that year jumped to $226,000. They did not think about Medicare. Their advisor did not mention ERMAA. 2 years later, in 2026, they each received a letter from the Social Security Administration informing them that their Medicare Part B and Part D premiums had been increased. The combined surcharge for both of them was $2,297 for the year. That Roth conversion, which was supposed to save them money in the long run, triggered a Medicare surcharge that erased nearly a quarter of the tax benefit in a single year, and they only discovered it after the surcharges had already been applied. Harold called the Social Security Administration to dispute the charge. He was told the determination was correct. His 2024 income exceeded the threshold. The surcharge would remain in effect for the full calendar year. He asked whether he could appeal. He was told that Roth conversions are voluntary financial decisions and do not qualify for the life-changing event exception. The $2,297 surcharge was final. This is not a rare scenario. Any one-time income event can trigger it. Selling a rental property, cashing out an investment account, taking a large required minimum distribution from a retirement account, even receiving a one-time payment from a deferred compensation plan. All of these show up on your tax return as income. All of them are included in the modified adjusted gross income calculation that Medicare uses. And all of them can push a married couple over the IRMAA cliff 2 years later, long after the money has been spent and the transaction forgotten. There is one more scenario that affects married couples specifically, and it is the most devastating. When one spouse dies, the surviving spouse's filing status changes from married filing jointly to single. The IRMAA thresholds for a single filer are exactly half the joint thresholds. A married couple earning $210,000 jointly is safely below the $218,000 threshold. But when one spouse dies and the survivor's income drops to, say, $140,000 on a single return, that survivor is now well above the single filer threshold of $109,000. Their IRMAA tier may actually increase after their spouse dies. Their income went down and their Medicare surcharge went up. That is not a hypothetical outcome. That is how the math works for thousands of surviving spouses every year. It has a name among financial planners. They call it the widow's penalty. And the surviving spouse almost never sees it coming because no one at Medicare or the SSA explains that a change in filing status can trigger a higher premium even when total household income has decreased. There is a way to fight this. If your income dropped because of a qualifying life-changing event, you can file Form SSA 44, the Medicare Income-Related Monthly Adjustment Amount, life-changing event form, and request that the Social Security Administration use a more recent year's income instead of the 2-year-old return. Qualifying events include the death of a spouse, a divorce, retirement, or reduction in work hours, and the loss of income-producing property. The SSA will recalculate your premiums based on the updated income, and the surcharge may be reduced or eliminated entirely. But voluntary income decisions, like a Roth conversion or the sale of an asset, do not qualify for this appeal. The surcharge stands. Here are your action steps. Step 1. Pull up your 2024 tax return and find your adjusted gross income online, 11 plus, any tax-exempt interest on line 2A. Add those two numbers together. That is your modified adjusted gross income, the number Medicare uses to determine your 2026 premiums. If that number exceeds $218,000 for a joint return, you are paying an IRMAA surcharge right now. Step 2. Before making any large financial move, including Roth conversions, asset sales, or retirement account withdrawals, calculate whether that transaction will push your income over an IRMAA threshold 2 years from now. Step 3. If your spouse recently passed away, file Form SSA 44 with the Social Security Administration immediately. You may be able to have your premiums recalculated based on your current reduced income rather than the joint return from 2 years ago. Step 4. If you received an IRMAA notice and believe the information is incorrect, you have 60 days from the date of the notice to request a redetermination. Medicare does not send you a warning before the surcharge hits. It does not ask whether you knew the threshold existed. It simply adjusts your premium and deducts it from your Social Security check. The only protection is knowing the rule before you cross the line.